Yo, what's up, guys? It's me. Used to be called Chinggis42. Now it's Tom Surviving Modernity. Don't ask me where the uploads are. I don't have an answer for you, but what I do have is an investment portfolio update. This is the second one I've ever done, and this one is on the 3-year anniversary from when I started investing. So this is a 3-year update on an investment journey, and the reason I make these videos is because they are useful for people that are thinking about starting their own journey. They're useful for people that have also got 3 years into theirs and they can compare and see what other people are doing. They're useful for those reasons, and the reason I know that is because when I started, I found these types of videos really useful. And finally, another reason why I make these videos is to leave a track record. Because hopefully in 30 years, 40 years, my investment account reads $500,000 to $1 million, and I can sail away into the sunset. That's the idea anyway. Yeah, so 3-year anniversary. Actually 2 weeks away from 3 years, but that doesn't matter. This is all being done on Trading 212 inside a stocks and shares ISA. So it's all tax-free. The main information is that my portfolio stands at around 17,500, or let's be more accurate, 17,400, and my total net deposits is 13,900. So my total returns since starting is £3,476, around 25% total returns. Now, you might think, okay, 25% divided by the 3 years, that's around 8%-ish yearly returns. And technically, yes, but also kind of no. And what I mean by that is, if I deposited my total deposits all in one chunk at the start as a lump sum into a savings account that gave 8% returns, then yes, what I'd have now would be the result. But because my deposits have been made throughout the journey, throughout the 3 years, to calculate my returns, my annualized equivalent returns, then we can use a little bit of Excel wizardry. And I'll explain what I mean in the next slide here. So this is a table that demonstrates, my camera's in the way. This is a table that demonstrates if I put my deposits into a savings account that gave 8% returns per year, and they don't exist, by the way, what the results would be. And the result, as you can see in the bottom bit here, after 36 months, my total account value would be 15,700. But that's way less than what I've got. And then so I've got this inside a spreadsheet. We can rejig the table for it to simulate a savings account that gave 15% yearly returns. Super impossible, by the way, they don't exist. And after 36 months, the end value is much, much closer to my total account value. So what this means is my returns are beating a 15% interest rate account. It's beating, right now, I'm beating 15% yearly returns. I don't expect to continue beating 15%. I think I've been really lucky with my choices and my timing. But yeah, that's great. 15% yearly returns. If it carries on like this, I'll be singing away into the sunset, very happy indeed. So of my total value of 17,400, about 40% of that is in UK dividend stocks. You can see the top line here. I've got two pies. A pie is just a collection of stocks. My UK dividend pie, which is made up of 16 UK dividend stocks, that receives about 40% of my funds, and I aim for it to make up 40% of my portfolio. The remaining 60% is my global ETF pie. And that is made up of 4 stocks. Well, 3 ETFs and 1 fund, but let's just use the word stock. And then finally, I've technically got a third pie, but that's just a space for the stocks that I'm waiting to sell. That's where I keep them. There's 3 stocks that I'm not actively investing into. I'm just waiting for a price. And once they hit that price, I'm going to sell those stocks. So I don't count them. They're not in this pie chart here. They're just the subs bench. They are the rejects and they'll be shipped off pretty soon. So let's break down my UK dividend pie into sectors, sector diversification. There's 16 stocks. So each stock is 6.25% of the pie. And so I've got 2 banking stocks, 3 insurance and financial services, 2 energy, 2 utilities, 1 telecommunications, 2 consumer staples, 1 healthcare, and 3 consumer discretionary. And there's a little pie chart there. I'll move my camera again. And yeah, we can get into those stocks now. So Lloyd's, for each of these stocks, I've got the total value of my stocks, how many shares, my average price. So of the stocks I own, what's my average price and the current price. And then using that, you can calculate the total returns. And there's also dividend yield. And so I'm going to go through these stocks now and I'm just going to tell you the returns. So Lloyd's, I'm up 77%. HSB, I'm up 50%. Aviva, I'm up 54%. Legal and General, I'm down 1%. City of London Investment Group, I'm up 20%. Shell, I'm up 6%. SSE, I'm up 4%. United Utilities, 11% up. National Grid, I'm up 10%. BT, I'm up 50%. Unilever, I'm up 1%. Tesco, I'm up 55%. GSK, I'm up 17%. Greggs, I'm down 6%. It says B&Q here, but the stock is Kingfisher, but we know them as the company that owns B&Q. That's the reason I've invested in them anyway. I'm up 22% with B&Q. I'm down 7% with Halfords. And that's my UK dividend pie. If you want to pause that video and look at the numbers, they're all there, but I don't want to get too bogged down in the weeds. Now back to my global pie, which takes up 60% of my investment funds. The 4 picks in there is 3 ETFs. We've got VUSA, which tracks the S&P 500. We've got VWRL, which is a global tracker. We've got VHYL, which is another global tracker with a slight bias towards higher dividend stocks. And we've got JGGI, JP Morgan Global Growth and Investment Trust or Fund. And that is a group of people picking stocks, and I pay them basically to pick stocks and they give me money. It's great. That's a global focus one as well. The first 3 are index trackers. They don't make decisions, they just invest in the best companies within certain criteria. JGGI is an actively managed trust or fund, so that's actually someone sitting down in an office and picking stocks. Just to break that down if you were interested. So VUSA, I'm up 26%, and because there's a lot more money in these stocks, because it's only 4 stocks between 1 pie, which is 60% of my funds, there's a lot more money in these ones. I'm up 26% with VUSA, which is £500. I'm up 15% with VWRL, another £400. I'm up 16% with VHYL, another £300. And I'm up 5% with JGGI, which is £100. Finally, onto my selling pie. These are stocks that I realised at some point I'm not actually in line with the long-term vision of this. I don't want to continue investing in these stocks. These stocks I'm all negative on. I'm down 16% on Taylor Wimpey. They build houses. I'm not sure how many houses are going to get built in the future. I'm down 6% with BP, and I'm down 7% with Rio Tinto. And all of these stocks, once they hit a certain price, I'm going to sell and be done with them. So getting towards the end of the video now. Sorry if this feels rushed. I just don't want to take too much of your time. On the left here of this table is the key stats at the time of my last portfolio update, which is in June 2024. So a year and 4 months ago. My value then was 10,000. My deposits was 9,100. My total returns were 900. My yearly returns using that first calculation was about 6 or 7%, but using the AER model, like I showed you in Excel, it was calculated that at that point in time, it was around 14% yearly returns. Now on this portfolio update, my total value is up 7,500, which is amazing. My total deposits is up almost 5,000, and the gap between deposits and value is just, it's grown, which is lovely, and you can see that in the total returns there. The total returns has massively gone up, and like I said at the start of the video, the yearly returns with the first calculation 8%, using the AER model, yearly returns 15%. So right now it's looking really good. However, I'm not a genius with this kind of stuff. However, I do need to say there's a lot of indicators right now that indicate that we could be up for some rocky times ahead. However, it's kind of been like that for the past 5 years, and all of the markets have carried on going up. And I suppose what I'm saying is, I wouldn't be surprised if there was a huge crash soon. And if there is, I'll be buying in all the way down and all the way back up. I keep buying in every week, every Friday. Buy, buy, buy. I don't time my buys. I just buy and buy and buy. It's called dollar cost averaging, or in my case, pound cost averaging. And yeah, that's it. I'm not a financial advisor, so don't do anything because you've seen this video. Make your own decisions. However, right now for me, investing is working, and I'll probably make another video like this in a year, maybe 6 months. We'll see. Thank you for watching the video. I appreciate it. Leave a comment if you are also on an investing journey. Any questions, I will answer all and any comments. Yeah, thank you for being here, and have a nice day.